Okay, I'm going to talk real quickly about some basics of interest rates from a consumer perspective. As you probably know, banks make their money by loaning money out and charging interest. Okay? So, again, as you know, a consumer will put money into a bank, and that bank will then loan that money out to consumers and for houses and businesses and buying cars, and that's how our economy gets its fuel to sort of keep going, right? The banking industry and the banking system is vital to understanding how our economy works. So let's say that you're this person right here, this happy little stick figure, and you can borrow money, and your two options, I don't know if you can see this, your two options are to borrow at 5% interest or to borrow at 2% interest, right? So 5% or 2%. Now, if you are a bank, right, what's called a creditor, you would prefer that they loan out at 5% because they will pay you back plus 5%. Whereas if you take a loan out at 2%, they'll pay you back your interest and pay you back your amount that you owed plus 2%. But if you're a consumer, if you're borrowing money, we call that a debtor, then you want as low as interest rate as possible because that will mean you pay back less money, which will make it easier for you to make payments, which means you'll have less or more money to spend on other stuff, right? So either way, if you, let's say you get a loan for a car, right? Here's our car. All right, I'm a great drawer, right? And let's say that you borrowed $10,000 to buy some car, right? So the bank gives you $10,000. You buy this car, and the car company, like everybody else, has bank accounts, and they take this $10,000 and put it here when you buy this car. So the bank now has $10,000, and now this bank will loan that $10,000 out to other people for interest rates, and those people will put money back into banks, right? So that money will go back into banks, and they'll loan that out, and so on and so forth, and so on and so forth. So the basis for us as consumers is we want to have as low interest rates as possible because it makes it easier to take loans out for us as consumers. Now, here's a tricky part I need you to understand. The lower the interest rates, okay, the more money will be cycling through banks. Now, you might be thinking, well, that makes sense because won't the banks be making more money at 5%? 100% yes. But at 5%, consumers will take out fewer loans than they would at 2%. And the more loans we take out, the more stuff we buy, the more stuff that goes back into the bank from the people that we buy. Then banks loan that money out, and then those people put money back into banks, and so on and so forth. So low interest rates are good for consumers, and they tend to get the system of loans out there more and more and more. The higher the interest rates, right? So if interest rates go up, it leads to slowing the economy down, right? When interest rates go up, it slows the economy down because people take out fewer loans. When interest rates go down, it leads to an increase in economic activity because we're going to take more loans out and buy more crap, and that money goes into banks, and then they loan that money out, and then people who borrow that money will buy stuff, and those people will put money back in banks, and those banks will loan stuff out, and so on and so forth. It's called a multiplier effect. And so it's really important to know the importance that interest rates play in our banking system, right? So the concept itself is pretty simple. Consumers want low interest rates because it's easier to pay things back, and low interest rates incentivize consumers to take out more and more and more loans, which expands our economy. If you're a creditor, you'd like to get more money back, but it also incentivizes taking fewer loans out, which tends to contract the economy a little bit. So that's the basis behind how interest rates form a really important part of our economic system, and we're going to be learning more and more and more about this as we learn about banking and the Federal Reserve and the money markets and finally monetary policy.